And welcome everyone. It's just after 1:30 Pacific time, and for those of you who are new, or for all of you, whether new or old, in either case, my name, as you see, is Glenn Thompson, and I've been working as a mentor with Pacific Trading Academy since the beginning, many years. Where today's topic is trend analysis, the power of trend analysis. If you'd like more information on any of the programs that we offer at Pacific Trading Academy, you have the contact information, our website, www.pacifictradingacademy.com, or you can also access us through the toll-free number 800-339-8588. If you have questions during the course of today's presentation, utilize the control panel area on the right side of your screen, and I'll do my best as we proceed through the slide presentation to address any questions, but as always, I have time at the end for a little more comprehensive redress. We are recording today's presentation, so you can access the recording of such because we archive the content. Again, welcome everyone. It's a pleasure, and we're going to discuss trend today. It is the focal point of all speculation. To the extent you are in line with the trend is the extent to which we have a capacity to be profitable, regardless of what market and what type of market operations you're engaged in, long-term, short-term, stocks, bonds, whatever the instrument is. To the extent you can maximize the amount of time that your positions are in alignment with the trend, we can accordingly improve our performance results. And so it's critical. It's the most important component of the process of trading, at least from the analysis standpoint, in my view. It's the purest form of trading to access and align with a trend. So I'll give you my thoughts on that through the course of today's program. So there is this polarity that exists. If I simplify this, our analysis of markets and our search for good trades, trend analysis versus everything else. And so I make a distinction in a broad sense between the two major classes or types of analysis approach one can use. Trend analysis, as I just mentioned, is the analysis that would serve to align your positions that you've established in a market in the same direction as that market. And then there's everything else. Everything else really is in the category of anticipation and an attempt to figure out when and where and how a market's motion will change. And to the extent you can do that, the idea theoretically is you have edge, you have advantage. If I can forecast or project before the others that are constituents of the market know when a market and how a market and where a market will turn, is the extent to which I can accumulate some advantage versus my counterparties in the market. So those are the two kind of opposite polarities of approach. One is follow, one is anticipate. Anticipation falls in the category of forecasting or projection. Trend analysis, or getting in alignment with a trend, is more or less a trend follower, or we're following the motion, and if there's more of that motion that will come based on an expectation of persistency, we have a corresponding opportunity to profit. And so there are two opposite paradigms, if you will. So how do you reconcile two very different and polar opposite, in a sense, approaches? Well, how to converge the polarity. I always start by following in my mind, or put myself in a mindset of trend following. In other words, and how do you do this? Well, it's very simple. Take a look at we visually inspect the system we're interested in. So usually for most of us, although there are other ways to do this, it involves looking at a price chart, a two-dimensional, flat surface, a plot of price as a function of time. There are other ways to examine and assess and determine and measure market behavior. That is the standard method. And just ask yourself, given any period of time, whatever it might be. Now, it will tend to be proportional to your average period of time that you play in a market. If you're a short-term day trader, you're looking at intra-period charts. If you're a longer-term trader, you're looking at daily charts, weekly charts, etc., longer term. But whatever the period of time is you look at, ask yourself a simple question. What's the net change in the price? What did the market or the system, the stock, bond, commodity, whatever the instrument is that you're focused on and interested in learning about, what is it doing? If you can determine from left to right the change, the translation or the delta in price, you're able to establish a current trend given any certain look back, the point from which you started through the present. And then you make an assumption. The assumption is that the market is most likely going to continue doing what it's doing. That is the most profound forecasting principle I've ever learned. I jokingly, although I really truly mean it, I'm nowhere near insightful enough to have ever come up with that on my own. This is an extension of a natural principle that primarily one Isaac Newton was responsible for, obviously. Not only do markets move and behave and are informed by this principle, but pretty much every system in our known and possibly the unknown universe follows this. It's an energy consideration. Markets, stocks, bonds, commodities, you name it, any financially freely traded market or system will tend to continue doing what it's doing until it's disturbed by some external force greater than that, that's currently at play. So again, that's my long-winded explanation to indicate I always start the process in the mindset of following until I shift to anticipate. So I'm vacillating or shifting or vibrating between these two mind modes, if you will, between following and anticipation. How do you reconcile? How to converge the polarity? Always start by following, and I continue to follow up until my anticipation or my forecasting indicates otherwise. What that involves is acquiring an amount of evidence that would suggest the system has received enough energy to disturb it from its current path. And that creates item number 3, a shift in my internal state from a following mindset to a forecasting mindset. Let me move this over here. All right. After the market, assuming it's imputed a change to the system, to the market, stock, bond, commodity, currency pair, whatever you're interested in, whatever the speculative instrument that you're trading is. After you've observed a corresponding change of course, a turn, and this is usually what technicians refer to as tops or bottoms, go back to step 1 and you reinsert yourself into the following mindset. And you start the process over again and just go through this process. So this slide indicates the step-by-step mindset that I find myself. Again, I always start by putting myself or allowing myself to fall into the following mindset idea until I've acquired a preponderance of evidence to indicate the odds shift so that there's an accumulation of factors, energy, vectors, you name it, whatever, that will disturb the system from its current trajectory and increase the probability for an alternate pathway. That is to say, a turn occurs, a shift. And then you wait for that shift if it's simultaneous, but at whatever point you see the shift, then you go back to follow. You go back to the step 1. It's a feedback loop to the first step. All right. What's a trend? Trend essence. What is trend? Something is repeating. It's the most basic phenomena in the universe, in a sense. What is the most basic form of repetition? Exact repetition. What does exact repetition lead to? Leads to symmetry. Well, symmetry is we may all share or have an intuitive sense or concept of what symmetry is. Basically, without getting into too much detail, it connotes, or it's this idea this symmetry is an indication as to the extent to which an object or a system remains the same regardless of adjustments to it. To the extent a system or an object, a thing, an entity, appears to be the same after a shift or a transition or some adjustment to it has occurred is the extent to which it is deemed or esteemed to be symmetrical. In that sense, the reference, the gold standard, the limit of symmetrical shapes, if you will, is the circle. It has infinite symmetry. In other words, no matter what the adjustment, it still appears to have its circleness, its circle attributes, its circle symmetry is how you refer to it. And this is a form of mathematics referred to as group analysis or group theory. But suffice that, leaving that aside, systems or objects, and we're talking about a financial market, we're talking about systems that are in motion. So it's a little more variables of detail, but the principle still applies. Market motion, again, will typically tend to follow a path or a course that requires the least amount of energy. It is an energy consideration, and that particular path will always be the one that is most symmetrical. So this slide illustrates, and it's based on the first law of motion. Again, one Isaac Newton's insights into how our things in our universe work. If I've got an object or a system at point A, that's the past, and then this would be the present, the now moment as point B, whereas its most likely future course will be a direct correlation of that, drawing a linear projection of that. I didn't say that is guaranteed. See, I'm not saying that the market or the system under study or discernment in question is guaranteed to end up at point C. I am saying, according to these principles of symmetry and energy considerations, the system is most probably going to end up at point C, given a linear transmission or push or persistency into the future. So that is the most symmetrical. Symmetry leads to this perfect linear type of activity. Well, fortunately or unfortunately, markets don't behave this way all the time. There are periods where you have asymmetrical or nonlinear type behavior. Needless to say, though, there are periods for which it is symmetrical. How can we in a systematic, objective way determine the most where the symmetrical outcome of a market will be? Well, it's a mathematically known as something called the second reflection, which is simply a rotation around the axes, the two perpendicular coordinates of a flat surface in this case. We could extend this out to a three-dimensional object, a cube, but that would introduce another axes, but just to illustrate, to keep it simple for the moment, I'll do it on a flat surface as you see on the screen here. If you want to know what the second reflection is, these points here in the what's labeled as point 2, the quadrant, is this. Imagine this is a coordinate system, coordinate 1 or quadrant 1, 2, 3, and 4. So the first reflection is accomplished via a 180-degree rotation around the vertical axis. So the second most probable location for a system, for an object, anything or any system, let's say, that started, let's say the past is represented by points of location here, is identified by the letters in quadrant number 2, and that represents a location in the past, in time and price, let's just say. Now, the second most probable ending point for any one of these points in quadrant 2, the second would be in quadrant 4 in the future, and that would be the first reflection. I've rotated 180 degrees from quadrant 2 around my rotation. Axis of rotation is my vertical axis, and that would end up having all of these points located in quadrant 4. If I then were to shift or rotate from bottom to top, the points that started in quadrant 2, affecting the second reflection or rotation, you'd end up in quadrant 3. And quadrant 3 represents the most probable, number 1, probable location in time, price, on the plane, let's say, where the points or the phenomena are, which started in the past in quadrant 2. So that's kind of a mathematical indication as to how one can know precisely, assuming based on an assumption of linear proportionality. Now again, fortunately or unfortunately, actually it's fortunately that because if it were all the time that market behavior behaved this way and there were no deviations, no excursions away from pure second reflection type behavior, then everyone would grasp this concept and we'd all more or less be doing the same thing, and that would have a consequence detrimental to the markets at large. So that's why I say it's fortunate that we don't have systems or stocks or bonds or any financial system that perfectly follows this second reflection behavior. But to the extent a stock or or some other financial market has linear behavior, is the extent to which we can more perfectly forecast, according to the second reflection series of rotations, its future location and time and price. All right. This is just a chart to illustrate the persistency in the stock market. One of the standard forms of pure trend analysis, and it's one of the oldest forms, if not the oldest form of technical analysis, is utilizing a simple trend line. And a simple trend line is just a linear line. If you're in a rising market, in other words, I look at a chart procedurally, and I ask myself from any given arbitrarily selected starting point in the past through the present, let's say, what's the net course? What's the net translation or change in price? There are only three possible answers to this question. A market, given any amount of time elapsing off of a clock, can only go, in a general broad way of thinking about it, can only move up from one point in time to a subsequent future point, down or sideways. Those are the only, so that simplifies, again, on a flat surface. So one of the ways to graphically illustrate this, and this probably came up with this a couple of 100 years ago, is to use a linear graphic, a trend line. And so we have a basic line that can be created by virtue of selecting 2 points. You need 2 points to draw a straight line. And then with the third point, in a rising system, such as what the stock market chart shows here, we're going to start with the standard protocol is to start with a bottom and wait for another bottom, and then utilize that. And then once it hits a third bottom, that's the confirmation of that line. And the idea, a form of analysis that was developed and created many years ago, more than 100 years ago, and as I said, it's one of the oldest forms of technical analysis around, is that after having established a trend line and having it confirmed by, in a rising market, a series of 3 bottoms. If it's a falling market, same concept in reverse, upside down, the inverse, the reciprocal. I'm working off of the excursions from the motion to the upside. The excursions from the motion, or rather from the downside, or the excursions from the motion in a rising trend, as we see depicted here, are the bottoms. So a falling market would, the maximum degree of excursion or excursion points are represented by tops. In a rising market or system such as this stock chart here, we're represented, the excursion maximal points are the bottoms. So you have a tentative trend line. You have the third right here, you have a confirmation. And the idea is, as long as the price action and the surges, the impulsive moves, and the pullbacks or the corrections respect that line, is the extent to which you would determine or define that trend to remain intact. And that is the oldest, if not the oldest, form of analysis. I think candle analysis might be, have been around for a similarly long period of time, but neck and neck. But suffice it to say, it's old. The reason it's not perfect, nothing is, but the reason it works as well as it does is because it's not perfectly objective. I always jokingly tell people, you could put 10 traders and technicians in a room, look at the same chart with the same trend line or set of trend lines, and you could get varied spectrum of different interpretations. It is the ambiguity, it's the grayness of the interpretation that allows for to the extent or for the degree of accuracy that you still have. If it were perfectly objective, such as a numerical based analysis, ultimately the binary interpretation would be such that everyone would grab it and understand it and apply it, and that would have a consequence due to the feedback property. The market would discount it, and it would no longer, its accuracy would begin to trail off. So for whatever the degree of accuracy or precision that a standard form of trendline analysis it can be expected to generate, it is as good because of its limitation, because it's not perfect. Otherwise, if it were perfectly objective, it would not be of any use to us whatsoever. So this is just a pretty good example of one way by which one can determine or discern and distinguish between the three major types of trend: up, down, or sideways. All right. Trend or change. Okay, so this is just a graphic. I have a number of different tools in my toolbox, in a sense, that allow for the alternate type of analysis. Again, there is projection or anticipation, which is one mode of thinking, which is what is often, I would submit that most traders, the majority of analysis focuses and concentrates and spends most of their time on enabling the practitioner, you and me, to have a sense or acquire and derive a sense as to when and how change will occur. It gives us probably on a very deep and kind of emotional level, it boosts our ego to be able to know that we can get ahead of the masses of counterparties and other traders, the crowd, if you will. Again, in my estimation, philosophically thinking, it's not as high a form, it's not as pure a form of analysis. It is what it is. I don't want to get off on too philosophical a tangent, but it is the majority of, if you look at any textbook, most of the tools, any theoretical, the majority of all analysis is focused on equipping and enabling practitioners to project and to forecast change versus projecting or anticipating the sameness or persistency of a current type of behavior. So these are, again, the two opposite modes of motion and behavior. They shift, and so market behavior shifts between the two. The circle, again, is the most important geometric structure from the standpoint of it has infinite symmetry. In other words, if you think of all the types of adjustments that could be made, you rotate it, you shift it, you translation along in the plane. Regardless, at the end, after having done to it any adjustment made to this structure, you're not able to discern that a change has been made. To the extent you cannot discern there's no discernible change to a geometric structure, let's say, after an adjustment or something has been done to it, is the extent to which it is said to have symmetry. To the extent that you make an adjustment to an object or a system, and after the adjustment is effected, you can discern a change is the extent to which it has a lesser degree of symmetry. So it turns out that the circle is a geometric shape that is very full of capacity to do analysis. One of the ways in which I utilize a circle is to project and forecast change. Given certain ways by which I can construct a circle, I'm able to project when in the future a market's going to have a top or a bottom, a change point. So the point where the market right here, at the point that would be tangent to the 3 o'clock position, if we imagine the circle to represent the face of a clock, or due east on the as if it were a shape for a compass, would represent a change. Again, the question is, the million-dollar question of analysis, or one of the million-dollar questions of analysis of financial systems, is at what point, what is the quantitative threshold, line in the sand, if you will, that represents the acquisition of sufficient evidence where there are enough factors that will overwhelm the tendency for the system to maintain its current trajectory and shift and switch rails, if you will, or switch to a different track. And that is, it's an easy question to consider, not necessarily correspondingly easy to answer. But it is the question of analysis because there are only those two modes of price behavior possible. So this is one technique I have, all right, to do that. This is just another chart to illustrate the trend line technique of the previous slide. Again, it takes two tops. In a falling market, we're looking at the tops to establish a trend line. In a rising market, as represented by 2 slides ago, we're looking at the bottoms, representative of the maximum degree of excursion away from what we're discerning to be the primary trend. And to the extent, once we get the confirmation from a third top in a falling market or a third bottom in a rising market, you have what's called a confirmed trend line. And to the extent the price action respects that line is the extent to which, again, you would go on the idea that that trend is still in effect. At the point where that line or the markets or the system violates the line is the extent to which the odds become greater that you are looking at a transition from one type of trend to an alternate trend type. All right, so this is just another graphic of the trend line. The basic, sometimes the simplest forms of analysis are the most, the purest and the most powerful. Simple trend line this is an old chart, dollar Swiss forex pair weekly chart, long term. Again, in a falling market from left to right, it doesn't take me but a fraction of a second to discern visually the course, up, down, or sideways. There are only 3 possible answers. If I want to graphically encase that or support that notion, I draw a trend line connecting tops, 2 tops confirm, or the 2 create the initial tentative line, the third point confirms it, and to the extent thereafter the market respects that line is the extent to which you can trust in the accuracy of that line, creating a demarcation for the type of trend that the system is in. Forex persistency again. Now here's a case where from left to right you're seeing the price action rising, and so I'm looking at the bottoms. So where do we, this is actually not a properly drawn trend line as I see this. Or actually, yeah, yeah, incorrect. I should have diluted. This illustrates something else. It's more of a central mean line, not a properly drawn trend line. So let me shift. It illustrates, this is a more correctly drawn trend line. Persistency in coffee is a commodity. You have a top. Falling market, you're connecting tops, 1, 2 tops right here. That is a tentative line. The third one confirms it. And to the extent you see the market respecting that line is the extent to which we expect that trend will persist. And you can see the continued persistency. These 2 slides go hand in hand here. Still going. This is the same chart. I don't know why the background is different color. All right, turning point triggers, external force fundamental events, and so again, one of the million-dollar questions of analysis is at what point do you make the mental shift from viewing, or do you shift from the mindset that indicates an expectancy for persistency of a market based on the notion of the first law of motion, a body in motion or a body at rest will remain at rest or in motion unless and until otherwise disturbed by some external set of forces. Where's the threshold beyond which? Well, here's this, before I get into that, let me see, are there any questions, I think? Okay, a lot of questions. Let me just briefly, before I kind of continue here. Can I see? Yes. Can you see? Someone saying not your first rodeo. Last what it was mentioned as a turning point for market. Yeah, well, so just, yes, I'm going to address that in the stock sector, March 29, which is tomorrow. So we saw you have to allow the precision, the 29th, we saw a reversal, stock prices, whoever asked the question, let me just, someone's asking about March 29 as a turning point. for the stocks. Correct. Maybe this is Mike R. So that's tomorrow. So we're seeing a reversal today. So allowing a margin of error, given you typically 3 units of time, I think nothing has changed. The subsequent one is May 3rd, just if you're keeping track of turning points. Turning point projection analysis, which is an area of research that I spend a lot of time doing and work I do, is certainly in the anticipation mode or type or category of analysis. So it's the kind of antipodal, it's the opposite of the pure trend analysis I'm discussing today. One is not right, one is not wrong, one is not better than the other necessarily. They're opposite kind of camps of analysis, if you will. I tend to have a personal preference for the pure trend analysis, even though, you know, I would rate and elevate the market timing as the most important analytical. Well, it is the very helpful. It's the second most important tool because it is certainly subservient to trend. If I had to have my choice, I would pick trend analysis. But in any case, yeah, the 29th is tomorrow. So to the where I, you know, right, it's either going to come in perfect as it does sometimes, and we see a corresponding sensitivity and response by the market to it, or it's imperfect. Allow it whatever your margin or window of opportunity is. So as I said right before I tuned in, I saw in today's, if you look at today's action in any of the major U.S. indices, we're seeing coming into today, we have been coming down for a few sessions. So it's logical to assume that given my theoretical projection, which I made weeks, if not, I don't remember when I made it, but again, at the same time, May 3rd, so that's out, still certainly out into the future. So I do this on an ongoing basis. But yes, I made a webinar in March 29, which is now here, is a turning point. Is it? Yes, it is still valid in my estimation, but ultimately the degree of accuracy is going to be stated by the market based on the subsequent price action. As the date of March 29 moves further and further, as it regresses in our rear view window as we go on the timeline, in a sense, its validity and reliability will acquire greater or lesser importance based on how the market's response is as we move along time, or through time, I should say. Okay. Let's see if there are any other questions. Someone's saying, market still valid, target please. I'm assuming you're referring to a price. That I have not worked out yet, Chef. That's actually easier to do. I just haven't in terms of target prices. Primarily, just so you know, first you want to determine and confirm whether or not the change has occurred, or is it just a micro, and it, you know, to what is the magnitude of rebound or response when a market arrives on at a certain time point on the temporal dimension, moving horizontally from left to right through time, at what amount of price change, or what academics refer to as price return, change in the level of price is deemed significant? Well, there's no one answer to this because it's ultimately in the real world, for practical purposes, it's a function of one's profit objectives, let's say, in a broader context of what you're trying to do. But suffice it to say, price targets, the plethora of tools of analysis that we can learn and study, and typically if you've been trading for any length you should know, or you can know. If you don't know it, you can learn it. It's typically a little easier, at least for me, to project price targets. But the importance of a target is only as good as the extent to which you think a market's going to move in a direction getting closer, more and more proximal to that target. I can project a zone of overhead resistance or underlying support. What good is it if the market moves in a direction opposite my price target? It's only meaningful to the extent in a real world, the ramifications are such that if I have a target and you start to see the price approaching ever more, you know, as a limit, that price target, let's say, great. If not, then it's a kind of it's a exercise. All right. But yeah, I mean, yes, price targets are more readily the plethora of the literature is filled with all sorts of techniques, be it pivot point, be it Fibonacci, be it Elliott, be it harmonic, be it there are myriad ways by which we can generate both price and time targets. So yes, I can readily come up with some targets. All right. Trend is the momentum of the vector force. Yes. Am I using astrology or numerology in time for the forecast date? Cost? Yes, I do that among other things. I use celestial and planetary cycles. I use geometric relationships. By the way, many of the geometric and more numerical time projection models are correlated with planetary cyclical factors. So and then even within that, there are many ways to do that. You have what are called aspects. You have there are periods in certain celestial planetary cyclical components. There are what is it? There's all sorts of terrestrial cycle and volatility cycles. There are just pure price cycles. When you get into cyclical analysis, we're talking cause and effect, which again is in the anticipation department or compartment of analysis. It is everything other than pure trend is arbitrary from the vantage point of, and it's being a little semantic, but what it's arbitrary is it's giving you and me, the practitioner, the observer, an indication as to what should occur. The concept, the emphasis being on the word should. You, me, every trader on this planet, any entity that's trading, to the extent you follow completely and blindly what you expect through your analysis should occur, is fine to the extent the market actually does it. You could have everything under the sun in a figurative sense that tells you a market should do something, but if for whatever reason it does something else and you are positioned accordingly to what it should be doing, you have a problem at that moment, or I guarantee you, you will soon, very shortly. It doesn't matter. There could be any number of factors that would indicate reinforce and aggregate what a market should do. As long as the market's doing it and you're positioned in alignment with that, great. To the extent it's not, for whatever reasons, unknown or unknown to you, is the extent to which you will be losing money from a practical standpoint. When market will turn? I guess by your question, Leon, if you're referring to the stock market, another viewer's question was, I had a turning point projected for the 29th of March, which is tomorrow. We're seeing price action today relative to the previous few sessions in the broader stock markets in the United States, where the price was falling. We are seeing some opposite type of price action today. So theoretically, you can project a point in time where you expect a system to change, say a turning point, and this is manifested by a top or a bottom on a two-dimensional surface like your chart. Okay, so it's either has turned already, in which case my comment would be my projected theoretical time point was a day late, or this is, the price action we're seeing so far or today is not part of a return. So my answer would be, given the price action, my guesstimate at this moment would be it's turned in response to my theoretical. So I was not perfect, but I was close, I guess would be the comment. But to get added confidence in that assessment, we'll have to wait for further price history to be traced on the screen. All right. Thanks, Gregory, maybe. Okay. Now, coming back to the presentation here, so I just want to indicate certain types of things that singularly or in aggregate, when I add them up to all together, the types of things for me, and there's no limit to the number of things one can look at to suggest that a market is shifting from one type of motion to an alternate. As we're it's an ever-growing body of ideas and relationships that market practitioners, people who study markets, traders, etc., analysts, etc., study to try and give them a heads up, a clue as to when the system characteristics of a stock, you name it, any freely traded market on any time frame. Okay, people like W.D. Gann said, when time and price balance, the market will turn. So that, that brings up the question, and I don't want to get into Gann analysis, but whoever asked, do I utilize planetary cyclical relationships? Certainly I do, and there are many ways to do that. But I also utilize other types of timing mechanisms, numerical, geometric. There are correlations I expect between all of these things. Harmonic analysis, which is a form of mathematics, which some people who are Gann practitioners believe that Gann utilized harmonic analysis, which has to do with harmonics that arrive from a circle. That also correlates with planetary or astro cycle analysis, because if you can utilize utilize the circle as a model for our solar system, and not even getting into or considering the dynamics of energy consideration. Think of it though, but Dr. Hans Hanula, that's his pen name, his correct name, Alan Larson. Dr. Alan Larson has offered up over the many years physical theories as to how some of the planetary cycles impact cycles in markets. And it's purely an energetic exposition of this, how the energy, so if the sun would represent the center of a circle and the planets would represent, in the orbits represent the points on the circumference of a circle, and how they alter the energy emanating from our sun, our star, etc. I don't want to get off on that, but that's part of what Gann analysis is. And there's another related form of analysis known as harmonic analysis, but in any case, when time and price balance, that means, what that means is, to offer, so as not to be so cryptic here, when time equals price. So one of the techniques that I have to project when a market's going to turn is I will literally take a price, measure a range of price change, and take that and set it equal to a given unit of time change. Is it the only technique that I use? Certainly not. In other words, from a bottom to a top or a top to a bottom represents, and whatever that magnitude is, in price we'll often see or have an interesting turning point correlation in time, and vice versa. The deeper principle, and certainly Gann was privy, laid insight to this or pointed this out in the early 1900s, whatever you do to price you should be doing to time. Whatever you do to time you should do to price. They are two different sides of the similar or the same analytical coin in a sense. Oscillator divergence, that's more common. The standard fare of oscillator tools like a stochastic or an RSI or whatever your preferred indicator is, often is another and different way by which you can acquire a sense that the attributes in the structure of a given type of market behavior may be shifting from one type to an alternate. Classical and or candlestick reversal patterns, things like head and shoulders, triangles, pennants, etc. They are things like classical chart pattern analysis, symmetrical triangles, rising wedges, etc. versus candlestick pattern analysis, which is an entirely separate field, kind of a cottage industry unto itself. Things like dojis, shooting stars, hanging mans, harem eyes, etc. That's another form of analysis that some of which indicates continuation of a given trend. Alternate patterns indicate more greater confluence of adjusted probabilities, such that you would be more expecting a change in the trend. Okay. Fibonacci and or harmonic retracement levels. This is Fibonacci analysis is another mathematical subset. It kind of, as a substrate, provides the foundation for the Elliott model, Elliott principle. Harmonic analysis is another form, different types of ratios that kind of correlate with interesting similar relationships we see in the field of music, harmonics of music. Curiously enough, we often find similar mathematical harmonic relationships in market behavior. Multiple Elliott wave embeddings. I tell people when I teach Elliott wave, one of the principles, when you have a succession of fifth waves that have stacked one on top, embedded one within another, it often highly correlates with trend terminal points and thus changes. Cycle period endings. Okay, so all of these are the types, some of the things. Certainly it's the short list. It's not a comprehensive list of events that would constitute an indication a market is going to shift from one type of behavior to an alternate. All right. So here's this just indicates a divergence from an oscillator. This is, I guess, a stochastic. Looks like a stochastic. You have classic divergence. You have a rising trend in the price. You have a top, a higher top, corresponding top, lower top on the stochastic oscillator. And it correlates highly. It has a degree of likelihood that has historically been categorized and observed to indicate a more that there is a corresponding correlation that you can exploit for change. It gives us some edge in projecting that in advance. Possible trend transition. I've developed. This is an RSI based on some analysis that George Lane, who developed the stochastic, did many years ago. I came up with an idea that it was kind of proprietary in my own sense. This was about 11 years ago, utilizing a 14-period RSI by which I can more accurately determine whether or not define trend, up, down, or sideways, define the state of a market. Is this a bull or is this a bear? And so if you have a chart that's been coming down for a while, any and all price action, I'm trying to remember, when the market rises off of a bottom, as we did here, is the question, a quintessential question, a perennial question, I should say, rather, at any point when a market stops falling and starts to rise, is it just another in a series of pullbacks, and we ought to still define our market to be in a falling market, a pullback from which we should look to add to existing shorts? Or ought we to assign and attach greater significance to this bottom? Is it a end of the bear, start of a new generic bull? Well, which one is it? That's a rubber meets the road question. How can one with greater confidence in the reliability of the answer so as to know what type of position, long or short position, to establish at any given one of those points? Well, one of the things I came up with, and it's very specific, is any and all price action after a bottom has been put in, let's say, insufficient to cause a 14-period RSI to take out 65, I'm going to interpret as just a rally in a bear. But I'm still overall defining in a broad contextual sense the market to be a bear market. However, once a bottom is formed off of, and then the market starts to counter their move, if it rises to whatever level sufficient to cause the RSI to take out 65, it is indicative that the odds are greater. I ought to redefine the price action, and more probably the market has transitioned from a bear to a bull. The similar counterpart, the opposite, in a rising trend, at some point a market's been rising for a period of time, and all of a sudden it stops rising, forms a top, and starts to come down. At what point ought you redefine your market from a bull, a simple pullback in a bull market, or is it just that, a simple temporary retracement to a bull, a buy the pullback? Should you be adding to existing longs in that case? And as such, dollar cost average, get on average lower entry, better price, or establishing new longs from a better buying the pullback within that trend? Or ought you to attach a significance greater, attach more importance to the top? Did that top in fact correspond to the end of the generic bull and the onset of a new generic bear? Which one is it? Well, here's the way you can do it using a 14-period RSI. Any and all pullbacks off of a top where the market's declining, insufficient to cause the RSI to break down below 40, I'm interpreting as just a temporary pullback, but I'm defining the broad context. I'm still in a bull market, and as such, my strategies ought to reflect going long. But if and when the market, however low it goes far enough to the downside off of that bottom to pull the RSI below 40, it's an indication the market is more probably transitioned from a bull to a bear, and I ought to more focus on short strategies. So the two thresholds using that form of analysis are 65 and 40. That's just one form of analysis. That's an idea that I came up with about 11 years ago to more precisely differentiate the two major types of motion. Right. Point of decision, this is just divergence. This is a falling market. Divergence, standard oscillator, bottom to a lower bottom, bottom to a higher bottom, classical divergence. An indication, more probably, you ought to shift your mindset from out of the trend mode to the forecasting mode, given this relationship, if you feel it's a valid, reliable, relevant concept to look at as an indication of a more probable transition of market behavior type. All right. Next slide. These are just the circles. This is just a repeated, iterated application of one of the things I do. This is a geometric technique that I utilize to project this works about 75 to 80% reliable in projecting turning points. Again, it's a technique. Old trend or new trend. Make new friends, but keep the old. One is silver as old as gold. I couldn't resist the old jingle from elementary school, but it, needless to say, is a valid point at where these are the decisions. You clearly see price action illustrated respecting the standard trend line. At what point will it not and break through that trend line? And typically we're going to look for a confluence of different factors, very different, when you've got 2 or 3 different relationships that indicate a transition is more likely going to occur. Then when you're strengthening the body of evidence, and then you shift from your trend mindset to the one of anticipation, and then you wait and watch and see, does the system confirm the aggregation of your body of evidence that would indicate a transition should occur? Does it occur? And then I'm looking to get on board that new trend, and then I shift back in my mindset. I go back to the mental compartment of following at that point once I see a transition. If you don't see the transition, then you chalk it up as a failure regardless of how many things. Again, everything other than pure trend is in the category of arbitrariness, meaning that it's an indication to you that a market should do such and such. It either will or it won't. And to the extent that it does, you wait to see evidence of it, and then you begin to follow that until the next accumulation of counter or factors that would be indicating to you that there's more likely a shift. Okay. Remember this concept, the path of least resistance, that the lowest energy state for any and all systems, markets, is to continue doing what it's doing. It's probably a survival energy, if I could anthropomorphize a market, in other words, imbue it with qualities human-like, and think of it in terms, all systems, natural, unnatural, organic, inorganic, alive, not alive, etc., internally as a mechanism, as a principle of our world and universe as we know it. Everything based on everything that we understand, all objects and systems tend to go and gravitate and move towards the state that requires the least amount of energy. Again, it's a conservation of energy concept. And so it turns out that a given trend's persistence is that type of behavior is the behavior that requires the least amount of work and therefore the least amount of energy, and is tantamount to its greatest potential for surviving. So if we think of it in that sense, this is the S&P. Again, look at a rising from left to right chart. You have a tentative trend line is established by a point and a secondary point at the two bottoms, the extreme representative of the maximum degree of excursion away from the primary trend. You get a confirmation of that line with a third point. So here's the lowest point on the chart. Confirmation you can draw, or the ability to draw a single linear graph, a line. The confirmation the third time, and as long as that market respects that line, that is a very time-tested way by which we can define and make at least a global distinction between bull versus bear. Very simple, but don't let its simplicity belie its efficacy and its reliability. Okay. Is it perfect? No, but it works when we apply it with other things. It's a helpful tool. This is a current chart. I printed this out last night. This represents the front month of June E-mini daily chart S&P. And so someone asked earlier, the question is I think the question was, do I expect that, are these dates still reliable? Well, we'll see. Time will tell, but we're kind of on the precipice of, tomorrow's the 29th. This was overnight. I don't recall what time I printed this chart out, but it was last night sometime in preparation for today's presentation. And so today, earlier, right before I tuned in, the S&P was at 2353. So you can see last night we were at 2342.5. Basically, if you can see that, that was at whatever time. Again, I can't recall exactly what time this was yesterday evening, but we have moved up since. This was kind of a, for those of you kind of candle aficionados, it's kind of a hammer type structure, longer tail, a little body up towards the top, not quite, but it's a bearish factor. You can see clearly from the top of March 1st, the market's been declining. We had a little zigzag type structure in there for those of you who want to get more into detail, but suffice it to say, today's action, again, just literally about 10 minutes before I tuned in, the market was at 2353 3/4, basically 2354. So we have moved up off of yesterday's low considerably. So my takeaway of interpretation given today's price action thus far is quite possibly that the market is beginning or has already begun to show a response that would exemplify its sensitivity to this point in time. Was it, ideally I would have ideally loved to see further declines into tomorrow, but it's pretty close. I am not surprised at the price action that we're seeing from yesterday through the present. Given my theoretical projections sometime in the past of March 29. My next time point that I projected particular to the stock market, as you see, and I had worked this out in the previous webinar, is May 3rd. I have not yet worked out any dates beyond that. I just have to do it, but it's not of immediate importance. It will be certainly of interest as we get more and more proximal to as we move forward. But so certainly the type of price action we're seeing in the broad equity sector today is not surprising given that I had this date, and I have about an 80% confidence in its being reliable. I usually allow a margin of 3 units of time, so if I'm on a daily chart within a 3-day window, so I think we're seeing price action suggestive. In and of itself, that would be an indication to possibly look, get out of shorts, establish longs if on the sideline, etc., etc. That's another function. The analysis gives us an indication as to the current state and the extrapolated future state. What we do with it is a function of our strategy and the factors that define more specifically who you are as a trader, short-term, long-term, what your resources, your money management, etc. This is just the analysis. Okay. All right. This relates to one of the concepts that W.D. Gann and others like him. One of my teachers, Jim Gann, certainly in a theoretical sense, although I never met him, I read his materials and studied it, but Jim Flanagan, one of my teachers in terms of long-term cyclical work, but also just basic Gann analysis, evaluating to determine as a mechanism of when we shift our mindsets from out of pure trend following to one of anticipation. So we go into forecasting mode, and you make that oscillation or that reverberation between the two modes of thinking constantly. We're looking. Recognizing the purer form of analysis is to merely jump on the bandwagon on a following mode, but understanding that at various points the system characteristics will change, and determining what for you will constitute the relationships which together would be sufficient to, in aggregate, be a stronger indication that the more likely the system will change. All right. So a very simple way to do this, and it's pretty reliable. It's not 100%. I would give it about a 75% efficacy or reliability rating. Evaluate a trend. And a trend is going to be twofold in its components. You have the impulse and you have the pullbacks or the retracements. Well, one of the things in principle, theoretically, one can do is just examine and mark and measure the magnitude of the pullbacks. And based on the data you get, you're able to utilize or work up, say, average type of pullback. And the moment you see what you think could or could not be, and if you're trying to determine whether or not any given motion of the price behavior other than impulsive, other than that would serve to further the market's course in the primary trend, however you're defining that primary trend, let's say between up or down. As one is another pullback? Is it just another in a series of pullbacks, or is it something exceeding that, in excess of another in a series of previous pullbacks? Okay, well, measure quantitatively, numerically, very simple, and there are many variations on the theme, but what is the average size of the pullback in terms of price on the two coordinates, time and price, and time. So for example, you see from this bottom here up to this top, that's an impulsive move. Now at that point I might have been looking at it from the vantage point of what happened historically. That might have been a correction with respect to the move from this top to the bottom. But you must define, and that's admittedly arbitrary, the arbitrariness is offset by the consensus and the consistency of the period of time that you're looking at. As long as you consider that the results you derive are consistent for to a period of time proportional that you utilize to generate the results, then that consistency will serve to offset the implicit arbitrariness of the analysis. So what I'm saying is, for example, using this as a chart, if this is your impulsive move from this bottom to this top right here, measure the movement, the counter move, and from the standpoint of time and price. How deep did it go in terms of units of price? How long did it last in terms of units of time? It was 9 days and it was $5.81. What is this? This is a crude oil chart. $5.81 degree of pullback or change. This one, you had an impulse, and then you had a 6-day period of time period. You had a $3 and change or 2-cent degree of magnitude of price pullback. Here you had a move that lasted 5 days and not such a deep pullback, $2.93. Here you had this move up to this top. You had an 11-day duration. You had a 568 magnitude change or pullback, etc. So, and then you might tally that and take an average. And your average magnitude of time and magnitude of price, the averages serve as a reference or the threshold by which you're then able, utilizing the history of the market as its own arbiter of how you can interpret its future. You see? So the moment you see a top form, as in this case here, and then you see counter motion, retracement, and your question in your mind arises, what to make of it? Should I attach a degree of, say, is this the end of the bull and as such the start of a new bear, or is it an opportunity, a temporary pullback? Well, utilize the history of the market as a means of determining the answer. The moment you see, and I tend to place more importance on the magnitude in time, the duration, as opposed to the magnitude of price, but both can be important, you see. So that's a very objective way by which you can differentiate whether any given pullback to the primary trend ought to be thought of as just that, a temporary pullback to an existing predominant, still prevailing trend, or is it something, when you see price action and market behavior that exceeds the average historical, it's an indication, if not definitive, that the odds are greater that there is a more transition, a more significant sea change at play. That's all. And so this is an indication where that you had right in here an exceeding of that, and to that extent I would have shifted my mindset and attached in retrospect greater importance to the top. Once I began to see a pullback that exceeded the parameters of the historical averages of pullback, that was an indication, aha, I ought to reinterpret and redefine and shift my mindset from following to one of forecasting and allow to see, did I see price action consistent with that, and if so, then go back to the following mode of mindset and get on board the new trend that has established itself at that juncture. All right. This is just same thing in the bean chart. I should have not, yeah, it's the same thing. These vertical lines represent time points. This for if you're an agricultural derivatives trader. These concepts will be universal, folks. They work for commodities, futures, securities, Forex, you name your sector, your instrument. In general, they work through time continuums, whether you're a short-term trader, intermediate-term trader, position swing, long-term investor, all of the above. Markets are self-similar. There's a fractal property, the structure in general. Now, there's a qualification here for very short-term traders. If I'm on a 4-minute chart or a 60-second chart or a tick chart, or if you're a high-frequency trader, very high frequency, it's a very specialized niche of trading. When you get down below certain time windows, very short time intervals, you get into behavior more Brownian motion, and so there are some adjustments that we need to take into account. And you're more trading, but everything is proportional. The principles theoretically would work, but we certainly would want to make adjustments given if you're a very high frequency or short-term trader. But in theory, most of the ideas will still be present and applicable, assuming we make adjustments that are in deference to the peculiarities that define a particular realm of price behavior. This is Forex persistency, the same. This is just more of a from one top to, it didn't quite make it there. Didn't draw that perfectly, but then it was confirmed here. So clearly just standard trendline analysis here on a Forex example. And these are two Forex trades. This is the current. This is printed out last night. This is the Euro USD. For those of you who are currency or Forex traders, this is a daily chart of the Euro against the USD. And I have indications. This horizontal line represents a price target. So someone who asked me about price targets earlier, you should in your repertoire of tools have a cadre of tools that allow you to project price points and time points. Most traders only focus on price, as you should. The fundamental precept of all technical analysis is that price discounts all information, the information that you know, the information you don't know, the information that the market knows, the information that the market might not know. It is all of that information, known and unknown, conscious or unconscious, is by definition, if one ascribes to the foundational precept of all technical analysis, is that price action contains implicit in it all of that information. And to the extent, therefore, that you're able to interpret the price action is the extent to which, even though you may not have an explicit comprehension of why and the what is occurring, you should be able to, in a broad general sense, when it works, to the barring the abnormalities and difficulties and challenges and deviations that the real world presents when we move from theoretical precept or conjecture to how the real world works. The infinite variableness of real world behavior creates degrees of complexity that are astounding. And this is why we have the challenges in forecasting that we do, or one of the reasons why. Okay. And it's primarily the nonlinear capacities, but in any case, I expect, and I congruent and consistent with this, I just about 2 hours ago went long in Euro USD. For those of you who are familiar with Forex, great. There are many, I'm essentially expecting further declines in the US dollar and appreciation corresponding in the Euro. And how much so? Well, this horizontal line represents that. This is a zigzag. That's another way by which you can generate trend or determine the trend. AB equals CD is another paradigm of pure trend analysis that one could utilize to determine the strength and the likelihood of persistency of a given trend, or the likelihood of an alternate trend supplanting an existing one. This is the dollar-yen. This horizontal represents a price target, so suffice it to say I'm expecting further decline in dollar-yen values. I did not put on a position, but you can there in another way. I'm short term. I'm actually long dollar yen from earlier this morning on a shorter term play, but longer term off the daily horizon view, I'm expecting further decline here. And so from a trend standpoint, I wanted to illustrate that, and this is more precise delineation of such. This is a price target area as indicated by the horizontal line. I didn't put in a trend line there, but that's my thought. These are current charts, basic, more or less currently. This is a trade of the week, the trade of the last month, and the trade of the future. And it highlights a piece of evidence that would be indicating that I am expecting a change. So it's one of the items that I did not mention. Pay no attention to the man behind the curtain. That is the phone going off in my office. I forgot to mute my phone. That'll stop in a moment, hopefully. All right, but we have these set of lines here. If you can see it, is the commitment of traders on a weekly chart. This is a 5-year view of the 30-year Treasury bond contract, and suffice it to say, I have a relationship that is very rare that indicates a buoying of Treasury bond prices. And so I got long about a month ago in the 30-year Treasury instrument. And you can see it highlights my shifting of pure, the trend from the top here, the recent movement is down. If this chart you could split in two. It's schizophrenic. Everything on the left is a bull market, everything to the right is a bear. So I think we're at another point of transition off of this bottom that you see a few weeks ago here. Clearly, I think the ultimate bottom might have been even a couple of months ago. But the idea is that we've got evidence. This is a commitment of traders report. Very rare profile here. You've got an extreme position by the red line, which are the commercials. Those people that I consult know, because I've been harping on this for the last 3 or 4 weeks now, and I've reflected that by the long position in the bonds. That's a trade I still like for those of you who want a trade of the moment or week or going out. It's a position trade. This is not a day trade here. And then a finer more fine view on the daily chart, same relationship, an extreme long, net long position, polar opposite by the blue line, which are the smallest specs. That's a strong recipe for appreciation in interest rate, nominal interest rate levels, in the nominal instrument, not in the interest rate. I would expect interest rates are going to go up, but there's an inverse relationship, but for other factors. I'm not certain what they are. But this relationship provides a correlation sufficient, almost in part, almost alone, not alone, but to suggest higher levels. Now, we've got some resistance in here. You can see the tops here, so that would be an acid test, but we're at 151 and change today in the bond market, and I expect we could at least get up another 2 points or so, and then 153.5 area, and then we've got that top. So if we break through that, it's off to the races in terms of further appreciation that I expect. All right. For those of you who trade stocks, I started my career trading equities. It doesn't matter. I'm a technician, so whether I'm trading Alphabet or Apple or Amgen or Boeing or Bank of America or soybeans, I always jokingly tell people it's kind of like a little idea. Whether you're trading a soybean or a jelly bean or anything in between, more or less the similarities between price action and market behavior are pretty much the same. Clearly from a technical standpoint, a fundamentalist would argue that possibly, and I get that. It's just that I think all traders, fundamental, quantitative, technical, again, my area of research is market timing. It's not strictly speaking technical, it's not strictly speaking fundamental, it's kind of in a gray, it's a quasi or a semi form of analysis. It is what it is. These are labels merely to give us context in our discussion and interpretations. But we've got clearly from left to right appreciation in Google prices. As you see, this is a daily chart of Google I printed out last night, a stochastic oscillator. You've got a pullback here congruent with a 78 Fibonacci off of from this bottom to this top, and we've got a pullback, and you have a key reversal kind of structure here. Or is it? Yeah, clearly that's a key reversal. This is last night. I'm not sure what Google, I didn't check it earlier today, but it is an indication to suggest that we're going to resume. the trend. So I don't see, so this is bullish. I don't have yet an evidence. I have in fact a Fibonacci form of analysis, which is in the arbitrary category, that is indicative, that confirms the trend. It doesn't indicate that the bull market is over. We had a pullback, and the fact that it has responded the way it has to the 78.6 Fibonacci level is an indication that the trend that the bull market is still in effect. If I saw the market take this out or take out the 100%, or notice the trend line, if you can see, I didn't draw it in from this bottom to this bottom, establishing a linear line, and then once it's confirmed, you know, now here we had this line drawn off of this bottom would have been broken by virtue of the price action from the top through yesterday's close. But let's see how egregious a violation, or how innocuous it is. Let's see. And I would submit so far that we're seeing price action evidentiary of the market's respecting of a certain Fibonacci level, which in this case is confirming that the bull trend is still in effect, that we have not yet seen an outright transition. So this is just for those of you who trade securities to show you I'm an equal opportunity observer. Okay. Any questions, folks? Now, that's okay. Someone, okay, I'll kind of, is the TLT bond trending down this week? Well, it was, and now it's moving up. So overall, this week, today is just the second day, we're seeing price action to the upside in the Treasury in the 10-year and in the 30-year. TLT is an ETF tracking bond prices and Treasury instruments. So overall, this week, it's up, unless something happened from the time I, got on the phone with you guys and then till now. But overall, the price action this week, I think, is higher relative to what it's been doing. Okay, and so we have been pulling back prior to this week, and so I interpret the pullbacks as just that. I don't see a more sea change. I think it's just a temporary excursion from the internal to the broader bull market trend that I think is in effect. All right, so let's see, working backwards to other questions if we have any. How do I find impulsive move? Well, Leon, that is a good question. I don't know, but you take a look at it, you look at an arbitrary, so it could be an arbitrarily or a non-arbitrarily selected segment of the market's history. You have to start, there are some assumptions that need to be made in all forms of analysis, and that's a more generic statement. That not only applies to market analysis, that applies to trying to learn in an investigatory approach to anything in the universe surrounding us. How do you learn anything? Well, we've got to start based on some assumptions. One of the points I made earlier is that in narrowing in on your question, how do we find an impulse move? Any impulsive move, what's a thrust? Well, it's a move from, it's change. It's a motion that reflects after the fact. Subsequently, you see the change from a bottom to a top or a top to a bottom. And so you can say, you can begin to, given a period of time for which there was some history that was created, and for that period of time, here's how you would, and my answer to your question would be, whatever you learn about the motion or the behavior contained within a window of time, assume that it has its efficacy or its impact will be proportional for a similar period of time projected out into the future. Now, let me qualify that. The information you derive, given that whatever behavior occurred for any given period of time you select, however you select it, arbitrarily or not so arbitrarily, you can assume will have a impact or a relevancy for a period of time similar but not in excess for the period of time you selected. So if I'm looking at the last 3 hours of behavior, I look at a price chart. Let's say it's an intraday chart, and I look at the last 3 hours of price action, and the net trend or transition of price was up. It's going to be one for any change, for any period of time you look at. Just ask yourself this simple question. This is pure trend analysis 101. What did the market do from beginning to end for that window of time? For the last 5 minutes, for the last 5 hours, for the last 5 days, weeks, months, quarters, years, etc., for the last 5 millennia. What did the market do for that period of time? There's only one of three answers. For our purposes, what I usually do to simplify life is I eliminate the sideways answer. Because not to say you can't profit in sideways markets, options, strategies, all clever. We have over the years developed all sorts of clever tricks to exploit sideways motion. But from a direct, it's easiest to extract the maximal return. You get the biggest bang for buck in a market's rising or falling. Curious, just as a side note to support my thesis here, it's not my thesis, it's the reality. Most beginning options traders think that the easiest way to make money is by selling premium. That's not true, but I know why a lot of beginning option traders think that. And we know also the statistics are so skewed in terms of options that, most of the retail public who buys options, most retail traders lose money in purchasing premium. Yeah, 70%, 80%, whatever the stats are. But also congruent alongside of that is that the biggest returns, albeit by the smallest minority of traders, in options trading is in long option strategies. I said that, let me come back to your question, Leon, about how do you know or find an impulsive move. You just ask yourself, you identify a segment of time. How would you know? Well, if you, for whatever reason, and this could be a quirk of arbitrary circumstance, if you tend to like being in a position, interposition, meaning you want to anticipate holding the trade for more than a single 24-hour window, I'd be looking at a daily chart or a weekly chart and look at it in that context. If my preference is for short-term intra-period day trading, I'm going to look at some intraday or intra-period chart. Whatever the period of time is that you've arbitrarily selected, even if it's not, whether it is or isn't, pick a period of time, ask yourself, what's the net transition? Up, it's going to be one of three things, up, down, or sideways. That's how you find your impulse until it shifts. And how do you know it shifts? Well, we never know with absolute certainty, but by the plethora of study, the majority of all the analytical relationships and tools and indications, you name it, pick your poison, as I jokingly tell traders. Oscillators, time-price relationships. For me, it's time. But for most traders, it might be a price point, a Fibonacci relationship, etc., or a moving average cross, etc., a candle formation, a classical chart pattern. It could be, there's no end to the things. When you have an amalgam of together of enough evidence that indicates that one mode of motion, up or down, is ended, it's more likely that a new regime is setting in. So, but how do you define or locate an impulse? Just selective window of time. Now, typically, there's another corresponding principle. It's a qualitative idea, but it's meaningful and relevant and helpful. In general, this is why there were 100 years ago, people came up with moving averages applied to financial systems. The military was using them for, well, hundreds of years ago for warfare, how to work out trajectories for cannonballs against your enemy. But moving averages in the middle 1930s, 1940s, basic moving average technology. And then someone got the bright idea to assign varying weights to moving averages, because the concept now is you ought to assign or give more credence to that which is more recent than that which is more further back in history, in time. And thus the moving average weighting schemes, EMAs, exponential moving averages, and all sort of algorithms that have been defined to adjust the weighting, the way more precisely you ought to establish or differentiate weights to data. Do I give more weight to the present than I should to the past? Yeah, in principle, probably so, to the extent there is any correlation. Okay. Any other questions? I kind of addressed that. I think that's it, folks. So again, it's just a matter of shifting back and forth in our mindsets between the two modes of behavior, one of following, and that's where, when I look at a chart, to the extent I can define a trend, up or down. And how does one do that vis-a-vis the last question I addressed? Just look and see visually what's the net change in price from left to right. If it's not immediately intuitive, do an endpoint to endpoint observational question. What is the price on the right side of my screen higher than it is on the left? If I'm not, forget the detail. That there's plenty of tools and studies and relationships we can exploit to more precisely determine the detailed structure of a system you're studying. All you want initially is just a basic sense from left to right for a period of time. And then understand whatever your takeaway is, you cannot assume it will be relevant for a period of time exceeding the period of time you use. It might be, but you can't assume that. It might be relevant for a period of time less than, exactly equal to, or greater. But having made your forecast based on an assumption of persistency of whatever the net change is for whatever you're looking at, assume it will not be greater or of relevant for a period of time greater than for what you're looking at. And then you get on board and follow that. And then you wait for your set of indications that that together would indicate that there's a greater body of evidence to suggest a change is more likely to occur. You wait for the change, and then you revert back to your following form of analysis. Folks, if you need more details on any aspect of today's presentation, you have the contact information on the screen. They told me to put the 50% discount for if you'd like the mentorship program for either anything that I do to get into more details or any of my coworkers. We have right now 2 or 3 other mentors that everyone has their different views on how to apprehend and understand and trade markets, and so I have my areas of expertise and specialty, and hopefully they're complementary to some of what the other teachers at our academy do. If you have any interest in some of the details, you know how to reach us given the contact info. Other than that, I hope you got something out of it and look forward to future meetings and presentations. Until that time, I wish you the best and happy and profitable trading in the days and weeks to come.